This is Before and After from Refinitiv. I'm your host, Johanna Botta. And in today's Before section, we'll be looking at global entertainment giant Disney, as well as multinational ride-hailing company Uber, both of which report last quarter results this week. And in the After section, we'll be checking out Caterpillar or CAT. If this has been the era of the mega corporation growing in power, then Disney might be the poster child. Navigating the modern entertainment gauntlet has been no small task. So how is it that the old school mouse has been able to fend off disruption and adapt to the new age? With huge investment, of course. The company's new streaming service, Disney Plus, could take a while to hit its stride, and until then, it will be a drag on EPS. The service is expected to rack up operating losses of $800 million in the first quarter of this fiscal year. And as Disney continues to digest its recent acquisition, Fox Studios, costs across the company are likely to remain very high. Though the good news is that almost no other company dominates the motion picture industry like Disney does, and the firm's film divisions enjoy very healthy margins of more than 40%. The bottom line, there's no doubt that investors and competitors admire and value Disney's traditional business, but it's the new streaming service that got investors giddy last year. Disney stock jumped more than 30% in 2019 because of the excitement about Disney Plus. But so far this year, the stock's down more than 5%, so it's well behind the broader market. Investors are no doubt realizing that all the innovation and expansion comes with costs, and this may be weighing on the stock. Revenues are expected to be $21.08 billion, up 37.7% from last year's same quarter. Investors have been reconciling estimates of quarterly earnings of $1.43 per share in its upcoming report, which represents a year-over-year change of minus 22.3%. So, are investors jittery about Disney's Q4 numbers? You bet they are. The launch of Disney Plus in November was widely viewed as a huge success when the company said it signed up 10 million subscribers in one day. But almost immediately after that launch date on November 12th last year, the stock underperformed the streaming giant Netflix by 30%. That's over a period of just 2.5 months. Those subscriber numbers will get updated in this report, and a bigger number and guidance is the key to predicting the stock's reaction. Analysts expect it to be around 25 million subscribers, but we shall see. Positive guidance on Disney Plus is the name of the game. If there's any good news on that front, look for the fast money crowd to narrow the recent performance gap with Netflix. Unicorn companies that lose billions seems so last decade. So will Uber get the memo and ever turn into a viable business for the long run? Well, it had a miserable post-IPO performance in 2019, with a price of $45 a share in their $8 billion race. But the stock has since then slowly recovered from its 2019 low of nearly $25 a share. The rally represents a 40% gain since then, and so far in 2020, the shares are already up 24%. This recent optimism reflects market confidence in Uber's CEO, Dara Khosrowshahi's plan to deliver positive EBITDA in 2022. But estimates from analysts still leave quite a bit to be desired. Many are anticipating a slight improvement on the top line, with Uber expected to report Q4 revenues of $3.699 billion. In Q3, Uber recorded revenues of $3.533 billion. Though many market watchers are expecting a revenue boost in Q4, earnings estimates look less favorable. Here, analysts are expecting negative earnings of $717 million in Q4. This represents a significant increase on Uber's third quarter loss of $585 million. Remember that it's often the case with growth stocks that investors focus more on top line or revenue growth as a justification for their valuations. But in Uber's case, the market will want to see the earnings losses slow down as well. That's because even the most bullish long-term supporters of a business will not tolerate the idea that greater scale comes with lower margins. So, if competitors drive down rates, and new labor laws force Uber to improve conditions for drivers, it is possible the industry as a whole might reset prices, and that could improve Uber's margins. Bottom line, If we look back at Uber's wild stock ride, its case is pretty clear-cut. If losses continue to spiral and there's no improvement on the price pressure from rivals, the share price could get hit hard. Better EPS, specifically on the back of better margins, would see the growth crowd continue to gobble up Uber stock. The 61.8 Fibonacci retracement level of 37.64 off the lows of 25 in November 2019 is a level of resistance we need to see cleared convincingly. Caterpillar had a gloomy outlook, guiding down EPS for 2020 by $2 a share. Not the news investors wanted to hear. CFO Andrew Bonfield said he expected to be somewhere between flat to down 5% for business in China. In his outlook for the U.S., both residential and non-residential construction is an expected decline in 2020. The stock sold off in a muted fashion, though, trading down 1%. Frankly, the price action should be taken as a bullish short-term indicator, given the somber outlook. We need to watch the 130 level, though, in CAT. A break below, and we could be at 120 in no time at all. A hold of 130 could mean that a lot of the pessimism is priced into the stock for the moment. There it is, Disney and Uber in the before, Caterpillar in the after. Refinitiv data throughout. This has been the Tuesday episode of Before and After. Please subscribe and hit the notification bell to ensure that you're alerted to all of Refinitiv's future market updates. We'll see you on Friday.